Yep.
Okay. All right, we're excited to introduce our speakers for today. Andrew Pavard, and we call him Andy. He's our training coordinator, Budget LoB, former federal budget and financial management leader at United States SBA, Treasury, and VA. Courtney joined us, Timberlake. You all are probably familiar with her as well. She's the Senior Vice President and Director of the Croddick Group, LLC, former Deputy Chief Financial Officer for HUD, former OMB Assistant Director for Budget, leading the Budget Review Division. And also we have our ASL interpreters on with us today, Rhonda Cunningham and Sarah Nutted. Please enjoy the forum. All you, Andy.
Morning. Today we're going to talk about budget execution and the dreaded SF 133 report. Our objective is to provide you an overview. So we're going to try to do a high level. Now, this is a difficult class to teach because it is very technical and there's a lot of detail. And so we're going to try and stay at a high level to give you an understanding of what this report, why it's done, and what it consists of. And then we're going to go through each of the 4 sections of the SF 133 in some detail. So our agenda is we're going to do an overview, then we're going to go through each part of the SF 133. We'll take a break probably after part 2 for about 10 minutes. Okay, let's go into the overview of the SF 133. The first thing to talk about is what is the purpose of the SF 133? Because this is like a statutory thing. This is something that is driven by guidance. So in Circular A11, it states that the purpose is, and it lays it out in some detail, is first of all, it fulfills the requirements in law that the president review the federal expenditures at least 4 times a year. So Congress, they pass the appropriation bills, but then they want, reasonably, they want to know what is happening with the appropriations that they have passed. So they require the executive branch to 4 times a year submit information on how the money is being spent. So this fulfills a legal requirement to Congress. It also fulfills a requirement about unliquidated obligations, unliquidated balances, canceled balance, and adjustments. And again, this is part of Congress's oversight because they want to make sure that they've appropriated money, that it's being spent for the purposes intended. And if there's big, giant, unliquidated obligations, that raises questions about, is the money being spent appropriately? So they require the president to report to Congress. And again, the SF 133 is that mechanism. It also allows the monitoring of the status of funds that are apportioned on the SF 132 apportionment. So as you may know from some of our other classes that we've had in the past, that after the law is enacted, the agencies must submit apportionments, which are a plan for spending money, to OMB. Then OMB, Congress looks at these plans. And so it's important that Congress receive information on is the money being spent in accordance with the apportionment. And again, SF 133 tells you how to do that. So it also provides a consistent presentation of information across programs within and across agencies. So think about it from Congress's perspective, right? They're managing this giant government with all kinds of agencies doing all kinds of things. If every agency were to submit to Congress their own way of showing money, if their own way of showing what unliquidated obligations are, of obligations, that would be chaotic and confusing. So the SF 133 establishes the standard terms and concepts that are used by Congress to understand our budget. It also provides historical reference because, these SF 133s have been produced for many years, right? And so they can now, using this data and in the standard format, see historical trends. And they can use those trends to understand patterns of obligations, that are required to operate under a continuing resolution, because Congress understands that, you know, in the normal course of business, sometimes you have to spend more money for certain contracts or maybe rent or something up front. So the rate of operations is not necessarily even across every month. And the SF-133, the historical data that it generates over time, helps Congress understand that. And then it ties the agency financial statements to budget execution. The compilation of an agency's SF-133 need to agree with a statement of budgetary resources. So you know how agencies do audits and they produce financial statements in the fall. And so the SF-133s need to track with a statement of budgetary resources. And we're going to talk more about that as we go on.
Andy?
Yeah.
Great job. Great job. Can we slow down just a little bit? We have the interpreters.
Oh, okay. Well. Sorry about that.
Thank you.
So it's early in the morning. So the next question is, how is the SF-133 produced? It's kind of a four-step process, which is laid out here. Agencies upload the financial data into the government-wide account symbol adjusted trial balance system. I know that's a mouthful, but it's commonly called GTAS. So the agencies submit data to Treasury's GTAS system. Then the Bureau of Fiscal Services reviews and analyzes the data, okay? And they make sure that the data makes sense. Then OMB uses the data to produce the SF-133, and the SF-133s are available on the web at the link here. In fact, frankly, you can just type SF-133 into Google and you'll be able to find where all the SF-133s for the entire government are available. So let's talk about the Bureau of Fiscal Service. They manage the GTAS system. And so the purpose of the GTAS system is to meet OMB requirements and to accurately and timely compile the financial report of the US government. Monthly GTAS reporting. So they want you to do the GTAS reporting every month. Even though the SF-133s go to Congress quarterly, Treasury wants to see it monthly. And this is part of the process to ensure that GTAS data provided to external stakeholders, OMB and Congress, is accurate. So what monthly reporting does is it allows Treasury to perform the month-to-month analysis of agency data. So that allows them to look at audit findings, and they, by looking at it monthly, then they can see problems before they get to the quarterly reporting. So they can identify issues earlier in a given fiscal year, and then they can fix the issues before the quarterly and annual report. And therefore, monthly reporting supports OMB's submission requirements and associated deadlines to Congress. It allows the agencies to be more accurate and efficient when loading their data, since agencies can learn month to month what's going on and what issues are happening. Okay, and this information is available on the web at the link there at the bottom. So the requirements for submitting data for SF-133. Unless otherwise specified by OMB, all executive branch agencies must electronically submit SF-133 data each quarter for every Treasury open Treasury appropriation fund symbol or TAFs. Again, it's submitted through the GTAS system. The link is there, shown there, of where you go to find this. Now, reports are cumulative from the beginning of the fiscal year to the end of the period. So, you know, you get your October data, then the next month, you get your September data, then in October you add the September plus the October to get the cumulative amount. Because one of the main purposes of the SF-133 is to monitor the use of funds planned on the SF-132, your apportionment that you do at the beginning of the year, and then you change it, you should contain the same level of detail in the SF-133 as in the SF-132. So your apportionments have to match your SF-133 reporting. So I just wanted to show you here that these are the deadlines. They're put out in this by Treasury on this website, and that you can see when they're due and when you can request extensions for deadlines and stuff like that. So this is just the Treasury submission deadlines. So this is an example of a SF-133. In this example, it's from the Department of Homeland Security. Now it's an old example from 2021 for fiscal year 2021. But you can see that you go through, hey, Courtney.
Hey, Andy, sorry about that.
Yeah, no problem. So we just covered through the introduction stuff and the overview, and we're in the overview. And what's going to happen is I'm going to present the slides, and then Courtney will kind of amplify because she has way more experience of this than me. So this is the actual report. You can see it comes out as an Excel spreadsheet with a filter, and you can see all the different, the different statuses. Again, here's the portal to find it. Now, later on in this class, we're going to go through these in some detail. So this is just to show you where we are. Okay, the submission to Congress. Section 8-132 of A11 states you must submit a copy of the SF-133 for November, July, and August, and each quarter directly to the Committee of Appropriations, House of Representatives. To the extent practical, you should submit all the reports for each independent agency, departmental bureau, or similar subdivision together and numbered consecutively. You may use printouts of the SF-133s from GTES. You may also encourage or make arrangements with the Committee of Appropriations or House of Representatives to electronically receive the information through OMB's public site, which shares the same reports as the matched budget committee. So basically what they're saying is, you can send up printouts, or you can try to encourage them just to use the website, but you still have to get the information to Congress. Do you have anything to add, Courtney?
Yep.
Okay.
That's a great summary.
So here's an important concept. There are 4 main reports in financial management in the federal government, right? There's the Schedule P, which is described in the OMB Circular A11, which produces the budget of the United States government, specifically the appendix, where it lists in detail the budgetary resources, the object class, and the program obligations for each and every account in the federal government's budget. And so that is created, that information, that data is collected on Schedule P, which is submitted to OMB via the MAX system, which we talked about yesterday. Then for execution, the first step in execution is the apportionment document, which is the plan of how you're going to spend the money, broken down either by quarter, category A, or by projects, category B, and that's described in section Circular A11, section 120. I think is this still confidential, or have they changed that?
The apportionments are now published on a website that OMB maintains.
Yeah, I should have updated the slide there.
I think there are, Andy, I think there are some apportionments that continue to be confidential. But
would they be like national security?
Yes.
Yeah. So the apportionment is your plan on how you're going to spend the money. And then what we're talking about today is the SF-133, which is described in section 130 of A11. And that generates the budgetary information that we're going to talk about the rest of the class. But then at the end of the year, after the year's passed, you do your annual financial report, which is described in OMB Circular A-136, section 235. And that's the agency financial reports. That's what gets audited. The auditors look at those reports to make a statement on their reliability and accuracy. So all of these 4 reports, and we'll show this later, use the same terms and concepts. So that the information can flow all the way through the process. And it's important to understand how that flows. And we'll talk about that as we go on. Anything to add? Okay. So that the basic kind of building block of the SF-133 and those other reports, the budget appendix, the apportionment, and the statement of budgetary resources, is the account. And there's different types of accounts. There's the OMB account number, there's the Treasury account number, and then there's a Treasury account, Treasury appropriation fund symbol, right? And so you can notice here that the OMB account is 9 digits. I'm sorry, 8. Yeah, that's 9. But there's this 1 4-digit at the end that's kind of the account identifier. And that flows through down to the Treasury accounts. Now, the Treasury accounts are a little more broken out. And then they, in turn, are broken out with the Treasury appropriation fund symbol, breaks it out by period of availability. So this 18 means it was available in fiscal year 18. 18-19 means it's a multi-year, so that is available for 2 years. And X means it's no year funding. So let's, anything?
Yeah, so I just wanted to reiterate that when you're talking about, they get very granular down to the period of availability. And that is, so for example, when Andy was talking about multi-year, you just want to make sure that you have the right period of availability that you're looking at.
And then this also allows every dollar spent to be tied to a specific appropriation, because the Constitution states that funds in the federal government may only be spent if they're appropriated by Congress. And so one of the reasons federal accounting is a little more difficult than corporate accounting, private sector accounting, is that you have to maintain that line of sight, that line of control from every single dollar spent to an appropriation act to ensure that the constitutional requirement of appropriation is met at all times. So that's the reason it has to be very, very granular. Like in my private company that, I operate, a dollar is a dollar and I don't care where it came from. I just put it in the bank account. But you can't operate that way in the federal government. You have to say, where did the dollar come from?
Because the money is only available. So if you're looking at that multi-year availability, those lines at the bottom, you can obligate the funds. For example, that first one where it's 069 18/19-1301, you can only obligate the funds in 18 or 19. You cannot, even if you don't obligate all of the money, you cannot obligate that in 2020, for example. So just to put that finer point on it and amplify what Andy was saying, you can outlay funds that have been obligated, but you cannot incur obligations that are not in that period of availability there, the 18-19 or 17-18, for example.
Yeah. So here's another example. So you see for the OMB, the first 3 digits are the agency code. So, and then the next 2 are the bureau code, and then the account symbol, which is the specific towards a particular account. And then you come down, Treasury then has an agency code, which I don't know why it's different than the OMB agency code, but it is. And then there's the account symbol. And then there's something called the Common Government-Wide Accounting Classification System that's used in the accounting system. And again, you have an agency code and an account symbol. And if there's any questions about anything we're covering, please feel free to put it in the chat, and we're watching it, and we'll try to address the questions. So SF-133s roll up, right? So for a Treasury account consists of the sum of the entries for each of the TAFs. So all the TAFs add up to a Treasury account, and a Treasury account has to be allocated out to all 2 TAFs, right? So it can't be money in the Treasury account that isn't in a TAFs. They all, and then all the TAFs can't add up to more than what's in the Treasury account. And so here just is a report that shows how that works. This is a kind of consolidated roll-up report. We'll go to the next slide. So the question is, which TAFs require SF-133 reports? So section 132 of A11, we always go back to 132, says you have to submit SF-133 reports for unexpired TAFs. Now, what is an expired TAF? So the period of availability for, let's say, a 1-year TAF, let's say if it was appropriated in 2017. So during the fiscal year of 2017, you can make obligations, right? So by the end of fiscal year 2017, you should have made all the obligations you're going to make on that account for that year. But then you have to liquidate an obligation. Remember, an obligation is a promise, is a sort of a promise to pay someone for something. So the government signs a contract that says we're going to give, Smith Consulting $1 million. That is an obligation, but the money hasn't gone to Smith Consulting yet, right? So there's 5 years after you sign the obligation to what's called liquidate the obligation. And liquidating the obligations means paying out the money. So Smith Consulting submits an invoice, and then the federal government approves it and pays out the money. So after 5 years, let's say that Smith Consulting has not fully invoiced for the whole $1 million in their contract. But at that point in time, even if there's money left on the contract, it's considered expired, and they can no longer invoice it against that account, and the account becomes, quote, expired. So what they're saying here is that for all the periods where there's unexpired funding, so like 2, 3, 4 years after the end of the fiscal year, you still have to submit an SF-133 on that money. Okay. And then, yeah.
Sorry, excuse me. It's been asked if you can slow down a little bit more.
All right, I'm sorry.
That's
okay. Well, did it? So also for credit programs, financing, liquidating TAFs don't have to have SF-133s, and you do not submit SF-133 reports for deposit fund accounts, receipt accounts, and closed TAFs. Any comments? Okay.
Nope, no comments, thanks.
So now we're getting to the 4 sections of the SF-133. It consists of the following sections. There's budgetary resources, and that shows whether budgetary resources are available for obligation or not. And the purpose is basically to tell Congress and anyone else who's OMB how much resources are available to spend in the account for the remainder of the fiscal year. And then there's Appendix F describes what that section is. And we're going to go through this. Then there's the second section is status of budgetary resources. Budgetary resources it tells you whether budgetary resources have been obligated or not. Again, it's Appendix F. And then there's something called a change in obligated balances. And so what's going on with the obligated balances? Have they changed or not? And then there's budget authority and outlays net, which shows the obligated amounts that have been outlaid or not. So we're going to go through each of these sections in some detail. So that, again, there's the 4 sections. You can see this is from OMB Circular A11, and it shows you there's the budgetary resources, which talks about unobligated balances, appropriations. It describes where you get your budgetary resources. Then the status of budgetary resources, it's looking at unobligated balances. You can see that a little bit there. And we're going to go through this in a little more detail later. And then change in obligations, you can see it's the bottom line is obligated balances start of the year, obligated balances end of the year. And then budget authority and outlays, net. So what's your discretionary budget authority, and then the outlays. Now we're going to go through this in a little bit. So where do you find guidance for each section? Appendix F of OMB Circular A11 provides the guidance for completing each line. So each of these sections is composed of various lines, and what goes in each line is told to you in Appendix F. And so we're going to go through that in some detail. So then we also have covered this. I just want to reiterate that they're all available at Max or on Google, the public SF-133s. So let's get into the budgetary resources, the first section. So the entries for budgetary resources are in Appendix F. The budget concepts are used to calculate budgetary resources. And see, and I just showed you an example here. What they have in Appendix F are very detailed definitions for each line. So for example, this line is unobligated balances brought forward October 1st. And it then tells you in very detail what constitutes that. And it gives you even sections to go through. So the key to understanding an SF-133 is to get out your OMB Circular A11, go to Appendix F, and then just go line by line and read what the definition of that line is. Does that make sense? I hope it does. So let's go through this a little bit. Now, Exhibit F1 is kind of a summary. Now, where Appendix F shows you the detailed definitions, Exhibit F1 is kind of the handy-dandy quick reference, because what it does is show you just the name, but then it also shows, and this is very, very important, whether that line is used in which of the four things we talked about earlier. So the SF-132, the apportionment, the SF-133, the Schedule P, and the Statement of Budgetary Resources. So this says that line 1000 is used in all of these, and then there's footnotes that provide some details. But when you go down later, some of these are not used, and some of these lines, like 1930, is not used in all of the reports. It's only used in Schedule P. So this Exhibit F1 is really important to crosswalk and understand how the line systems work. So here's just some of the more common entries that show up in the Statement of Budgetary Resources. And it's kind of a good idea just to kind of learn these if you don't know them. But line 1000 is unobligated balance, right? And that's the balances that are not at the end of the fiscal year. You may not have obligated all the funds available in a particular account. And so that what's left over is the unobligated balances. And that is in 1000, it means it's carried over from the previous year. Then there's discretionary appropriations, 1100. There's 1200 is mandatory appropriations. And when we say appropriations, we mean new budget authority created by an appropriation law or a mandatory appropriation. Then there's 1700 is discretionary spending authority from offsetting collections, which is your Economy Act transactions and other reimbursable type things. And you can have it, see it's either 1700 is discretionary, 1800 mandatory, and then 1940 is unobligated balances expiring. So that's the balances that you didn't obligate that you can't carry over to the next year. And then 1941 is unobligated balance at the end of the year. And this is the money that becomes the 1000 in the next year. Okay, any comments, Courtney, or any?
No, I'm answering some questions that have come in through the chat.
Oh, great. Can you just
I've been
highlight?
typing, sure. I had a question about, what Schedule P stands for, and just the program and financing section within Max, and then what do the U and E codes mean or stand for unexpired versus expired. So those are in the chat if folks need to refer back to them. And Andy, there's one other question. Can a treasury account number have more than one fund code?
And I think the answer is no, right?
I think that's right.
Yeah, it's because they have to have unique identifiers, because again, every dollar has to be traced back. So it has to be a unique identifier. Okay. So now let's talk about what is the definition of budgetary resources. Now, A11 again defines provides a definition, and I'm going to read it. Amounts available to incur obligations in a given year. Budgetary resources consist of new budget authority and unobligated balances of budget authority provided in previous years. So you can think about this as a formula. It's your unobligated balances that have been carried over plus your new budget authority equals your budgetary resources. Okay, it's a pretty straightforward formula. But then you got to look at what constitutes new budget authority, right? New budget authority equals the sum of the 4 forms of budget authority. And their 4 forms are listed here. There's appropriation. Now, appropriation is a law that's been passed that gives you budget authority, right? And it's the normal things that we try to get. In theory, we get them through appropriation acts. In reality, we get them through continuing resolutions and big giant omnibus bills. But it's a law. It comes from a law. The second one, I'm going to let Courtney, can you explain borrowing authority and contract authority?
Borrowing, okay, absolutely. Borrowing authority is used in a variety of circumstances, but the balance of borrowing authority tends to be in credit programs where agencies will borrow funds from Treasury in order to make loans to non-federal borrowers. There are some other types of programs that do use borrowing authority as well. But that is the main, probably the largest amount are the credit programs that incur borrowings that have to be repaid.
And then contract authority?
So I am less.
So contract authority is one of these really weird, rare things that we're gonna.
Yes, which is why, yeah.
It's exactly. You don't normally have to worry about contract authority. The two that most of you will worry about is appropriation, and then the final one is spending authority from offsetting collections. Now, spending authority from offsetting collections is a kind of weird concept, and let me try and walk you through it. So when Congress, for an account, appropriates a certain amount of budget authority, it says you can go and spend that budget authority for that account. But an offsetting collection is when you get money from non-appropriated sources that you can use to offset your appropriation. So if you have $1 million appropriation, right, you can spend $1 million. But then if you have an offsetting collection of, say, $100,000, that offsets $100,000 of that million that you can also spend. So now you can expend them essentially $1.1 million if you have $100,000 in offsetting collections. Now, there are basically 2 types of offsetting collections. One is if you collect revenue from if your agency collects revenue. Now, normally when revenue is collected, it has to be deposited in Treasury. But if there is a law that says that that revenue may be, essentially spent by a particular account, then you can use that as offsetting collections. It's important to note that it has to be a specific law. So an example of that might be fees at the National Park Service for going into a park. So there, the agency is allowed to take the fees and spend the money for the purposes specified in law by the account, and Congress has said that, and that becomes an offsetting collection because it essentially offsets the amount of some part of the amount of money that is needed from appropriation. The second is reimbursable agreements, where the government is allowed, again, through some statutory mechanism for one account to provide services to another account. And so it's an intergovernmental transactions. Working capital funds can be that kind of thing, and other types of intergovernmental situations. So if I hope that makes it, I hope that is clear. And I'll take a minute there because it is a little bit difficult concepts. Is there Any questions on offsetting collections? Do you understand what we just explained? And do you have anything to add, Courtney?
Nothing to add. I'm answering some questions in the chat.
Okay. So that's a key concept to understand these 4 types of budget authority. So your budgetary resources are made up of those 4 plus unobligated balances carried over. And the important thing to remember about unobligated balances carried over is that you have, or brought forward is actually the technical term, is you have to have statutory authority to do that. If you don't have statutory authority, the money lapses at the end of the year if it's not obligated, and then it becomes recorded on your budgetary resources line as 1940, if you remember from the previous slide. So now let's take a look at a statement of budgetary resources, and this is from July 2023, and it's the Small Business Administration. And so the first thing you see is the TAFs, right? And you can see that what kind of fund this is. You know, it's an X, so it's a no-year fund. And then you can see that in this particular fund, they brought a lot of money over, $960 million and 56, you know, all this money. This is what was carried over from the previous year. And then they did some recoveries from unpaid obligations in the past. And that added $2 million or almost $3 million. And you can see each one of these things. Now, if you want to understand the details, again, you go back to Section 82 of the OMB Circular A11. And you can see here, there's a lot of offsetting collections, right? This is 1,700 spending authority collected. So that means they collected $42 million that they can use to offset. Then you can see 1,740, and then it tells you the total at the bottom, the total budgetary resources of over $1 billion. Okay, so so let's go to the next one for examples. So let's do just kind of a questions and answer section here. The 3 questions are: what is the OMB account number? And go ahead and put it in the chat if you could. What is the TAFs, and what is the period of availability of this TAF? So what is the OMB account number? Period availability is no year. I see no year, 28 and 100. Yeah, I see some answers. So here's the answer. What is the OMB account? The OMB number is the top here, right? This is the OMB account number. The TAFs is below it, so 703X. And since it's an X, it's a no year. Okay, so you see how this works? So let's try it again for some more questions to see how this works. For Q1, and that's this column here, what is the carryover from the previous year? And for Q1, what is the reimbursable amount already collected? And for Q1, what is the total budgetary resources available? So go ahead and put those in the chat. Let's do Q1. What is the carryover from the previous year? Yep. So what the 9-0. So, and what is the reimbursable amount? You can do just the first, how many millions is it? Okay, and what is the total budgetary resources? Okay. Yeah, there you go. People are getting it. So here's the answers, right? So it's line 1,000 is obligated balances brought forward. That's the 92. For Q1, what is the reimbursable amount already? And it's already collected. Now there's an issue with reimbursables. Sometimes in your apportionment, you put in anticipated, I think, Courtney, am I getting the term right? Anticipated collections, and you base apportionment on that. But in this case, they've actually collected the funds. And then the final one is this is, you know, what's available to be spent. So this is a very important one.
Yeah.
And so Q1, I guess I should have maybe, oops. I should have actually, I should have pushed it into November. I pointed at the wrong thing there. That's my mistake. Okay. So question, what is the, yeah.
No, sorry, go ahead, Andy.
No, go ahead.
I was just gonna say, somebody asked, is everything in 1700 reimbursable?
I think the answer is yes. Well, no, it
That's it.
could be collections from, I'm sorry, it could be collected from revenue, like fees or something. So it's not necessarily reimbursables. Is that correct? Did I get that right?
Yes.
So remember, there's two types of 1700s. There's reimbursables from where you're getting money from another federal agency. And then there's collections from revenue sources, which may be outside the federal government, like people paying fees and things like that. Oops. So what is the period availability for this TAF? And then we'll get a little, let's just do that first. And then I'm going to ask, why do you think the amount in 1100 changed from November to December? And why is this amount precluded from obligations? So the question is, what's going in there? So let's take, what is the period of availability in this TAF? So I see 23, 24, we got that right. Why do you think the appropriation amount in 1100 changed from November to December? And we have somebody from SBA, so they probably can tell us. $11.30, we got the answer. So $11.30 is due to the CR. So the CR, they had an appropriation, but the CR said you can only spend so much amount of it. And then what happened is, someone also put in the chat, the in December you got the full year appropriation, and that's why the amount of 1100 went up. And notice how this is the way people, if you're new to budgeting, people start talking where they say 1100 and they mean the word appropriation, or they'll say 1000 and they mean unobligated balances brought forward. So it is kind of important to learn these kind of key terms, key line numbers, because that's the way people talk. And so here it is. Here's the answers for that question. Okay. So any questions on that? So now we're going to move into the status of budgetary resources. And here again.
Hey, Andy, before we move on, we had a question about using monthly reports and when you prepare the 133s.
I'm sorry, say it again, please.
Sorry, the question is 133s are prepared quarterly. Does this depend on the agency? And the person who asked the question said our agency does it monthly. And I think the answer, and Andy, you should help me out here or clarify. Agencies will prepare monthly execution reports, but the 133s themselves are generally published quarterly.
Yeah, I think so. Like we covered earlier in the class, you submit your data to Treasury monthly through the GTAS system. And so that's why a lot of people think of GTAS as the 133. So what they're talking about is, yeah, every month I have to submit my data to Treasury. And a lot of agencies compute the SF 133 monthly for their own internal purposes and to reconcile and make sure that what they see on the Treasury generated 133s is correct. So agencies generate the data monthly, but then OMB submits it to Congress officially on a quarterly basis because that's what the law requires. But they kind of generate, you'll see in the examples that I showed, they generate the data monthly. And that's the reason when we talked about that earlier, is because if you generate the data monthly and analyze it monthly, by the time you get to the quarter, you're more likely to have the data correct. So that helps make sure that the data is submitted to Congress correctly. But the legal requirement is quarterly, but the practical and OMB guidance submitting and Treasury guidance submitting information is monthly. Does that answer the question?
Andy, we also have a hand raised,
Okay,
Michelle.
Go ahead, Michelle. Okay. And then, so they said, why was the amount excluded? The reason the amount was excluded, and we're talking about this $4 billion or $4 million dollars was excluded, is because under the CR, they were operating under a CR at this point. You couldn't expend your whole obligation. You had to only do the amount for the rate of operation. So for the period of the CR, this is listed as precluded from obligation. But notice when the regular appropriation is passed, you notice they got more money, so they got more than they would have got under the CR. And you notice there's no money precluded for obligation anymore after you get the regular appropriation. So the question, during a CR, what is loaded in the 1100? In the 1100, you load, again, it depends what's in the law, but most CRs say that it's for a period, and we have a whole class. Hey, we're having a whole class on this on Thursday, so we'll go in great detail. But the short answer is, usually a CR is for a specific number of days. And so then they create what they call the rate of operations, which you take the number of days, let's say it's a 100-day CR, and then, so 100 divided by 365, so that's the portion of the year, and then you apply that to the previous year's appropriation. So if last year you were appropriated $10 million, and then there's a CR for 100 days, you take 10 divided by 365, and then you multiply that by your $10 million from last year. That's the quick answer. But again, Thursday, come to our class, and we're going to cover that in painful detail.
And just to amplify, the point is that the continuing resolution is for agencies to continue operating under the same terms and conditions as the previous year until Congress actually enacts new appropriations. So, just to amplify that.
Okay, now we're going to go through this section and then we're going to take a break. But the entries for the status of budgetary resources. Again, Appendix F and F1 tell you what to do. And this is the summary from Appendix F1. And you can see what they're doing is you're looking at the new obligations and upward adjustments. And now here you're looking at Category A, which is by quarter, and Category B, which is by project. Then you're looking at your reimbursables. And then you're calculating your unobligated balances. So that's what, let's go to the next slide and get into this. Now, again, there's a formula. And this is a little complicated. And I want to go back to the actual A11 in a minute and show you what it looks like in A11. But again, there's a formula. It's direct obligations plus reimbursable obligations equals total budgetary resources. And so the direct obligations is broken out by Category A. Now, when you do an apportionment, there's two ways of categorizing the funds in your plan. You can do it by quarter, which is, essentially breaking out the plan spending by, this is much we're going to spend in quarter one, this much we're going to spend in quarter two, this much in quarter three, and this much in quarter four. And then the other way it can be broken out is by project. Because for certain things Congress cares about, they know these projects they want to know about. And this can be like a big IT project or a big program or something like that. And then there's a tiny bit of very rare things that are exempt for apportionment. That's a very, very rare and tiny thing. So that equals what's called your direct obligations, because it's going directly from budget authority specified in a law, sorry. And then there's reimbursable obligations. And then they also are broken out in your apportionment by category A, category B, and exempt from apportionment. So in the 133, you show your funds by these same categories in the report in this section of the SF 133. But then there's also another breakout. There's new obligations from unexpired accounts, and then obligations, upward adjustments for expired accounts. Now, this is a weird thing, this 2180 obligations, upward adjustments, and that's basically when the accountants made an error and now they're fixing it, right? That's kind of a crude way, and the accountants would probably not go with it. But this is upward adjustments or accounting fixes in the data. And so hopefully they're not too common. So this is new obligations and upward adjustments. Okay, Courtney, do you have anything to add on that?
Yeah, I just wanted to mention that upward adjustments are not necessarily because there was an error. There are cases where obligations are made late in the fiscal year, and the paperwork just doesn't make it to the agency in time, before the end of the fiscal year. So upward adjustments can be made for errors, but also for reasons of just a timing issue. For example, one big example is student loans, that get obligated in August before the start of the school year. There is often paperwork that doesn't come into the system on a timely basis. So just as an example.
So there's a question about, can you send a sample SF 133? We can actually, you can go to the public website, and the easiest way is type into Google SF 133 and you'll find it. Or I also included links in the slides. And there you can get the SF 133s for any agency. You can find your agency and you can look at your agency's SF 133. So there, and with this status of budgetary resources equation, you're really talking about two different concepts that equal the same thing. It's direct and reimbursable equals total budgetary resources, but also new obligations plus the unobligated balance at the end of the year equal total budgetary resources. And let's just talk a minute for unobligated balance end of the year. It's the apportioned unexpired accounts, right? And those exempt from apportionment, which again, I think is very, very rare. And then unapportioned unexpired against an unexpired obligated balance. And again, each of these lines, we don't have time to go into too much detail with each of these lines, but the very kind of granular definitions of these are available in Appendix F of OMB Circular A11. So we're just trying to let you know about it. Okay, so let's look at new obligations and upward adjustments. So notice how these two, this is another way of saying that breakouts of two different totals of the same thing. So it's direct and reimbursables equals new obligations and upward adjustments, and also new obligations and from unexpired accounts and obligations from expired accounts equal new obligations. So this shows the, just way of thinking it. But again, to get the precise definitions, go to OMB Circular A11. So again, it's direct and reimbursables equals this, and unexpired and expired accounts equals this. So let's take a look at what it really looks like in a sample SF 133. So the question here is, what are the three lines that add up to the total budgetary resources? I know I went through this fast, so you kind of read it and try and figure out which are the three lines here. And when is the account expired? It's after 5 years after. Usually it's 5 years after the end if it's a last year period of availability, except no year funds don't expire. Just a question, responding to a question. Okay, let me show you how this works. So what are the three lines that add up to the total budgetary resources? It's the new obligation lines, right? The unobligated apportioned available in the current period and obligated balances of portions anticipated. So those are the three things. Let's try it again. At the end of November, what is the amount that would be available for carryover to the next year? And it shows you right here, it's this line, portion unobligated balance end of year. So again, what I'm trying to give you just a few examples, but the trick is to go I'm saying this over and over again, is to go to OMB Circular A11 Appendix F. All right, so we've covered the first two sections. We're going to take a break we'll come back at 10:05. During the break, if you have questions, you can go ahead and put them in there, and we'll begin the break by answering questions, and then we'll move on to the last two sections of the SF-133. Yeah, there's plenty of examples, and maybe I'll do that to start. The break will be till 10:05. we're going to start in about a minute, or actually we're going to start, it's 10:05. We're going to start up again. What I'd like to do is there's been some questions about sample SF-133s, and I'd like to just take a minute and kind of show you A11. And this is the samples that are in A11, and they have various samples for different kinds of accounts. And you can see here, then they explain things in some detail. So it's really, you know, if you take anything else from this class, is just go to the AMB Circular A11, Section 130. And then, you know, so they have different kinds, an annual account with reimbursements. And then they talk you about a no-year account with quarterly report. And so they give you different examples. And here's a multi-year account. So they give you examples and show you how it's supposed to be put together. And also, since most of us in this call probably aren't putting together SF-133s, what most of us are doing is trying to understand the data in an SF-133. So then I'm going to take a minute and also show you the actual, I've been talking a lot about Appendix F. And so I wanted to actually take you there. Sorry, that's taking me a little bit to navigate, but I think it's important to see what is actually in the document so you'll feel comfortable going to it. Sorry about this. So you can see S-133 is, whoops. So it's Appendix F. You can zoom it. I wanted you to see that here is the key thing that shows you what sections are used in each report. So the 132 has these. Notice the 133 has a lot of status things that are not in the 132. Then the Schedule P, which turns into the President's Budget Appendix and the Statement of Budgetary Resources. It shows this. Then it shows you that line numbers are broken up largely in big chunks. So 1000s tell you about budgetary resources, 2000s tell you about the statement of budgetary resources, 3000s tell you about change in obligations, 4000s budget authority outlays, and then these others are for other things. And then it goes and
Hey,
go ahead.
Andy,
Yeah.
somebody asked, are you able to zoom in at all?
Oh, let me try. This is not working. There, that's better. Is that better? Sorry.
Oh, that is definitely better.
Okay. So what I was saying, and just gonna repeat myself a little bit, the first of the four digits in a line number tells you what section it's in. So 1000 is budgetary resources, 2000 statement of budgetary resources, 3000 change in obligated balances, and 4000 budget authority, and so on. So that's important. Whoops. So that's important to understand. Well, I'll learn how to do this someday. And then you go through. Now I can't. Okay, there. Sorry about this. But then what I wanted to show you, and I can't, is here, like each down here, you can see the 1000. Sorry. Should have rehearsed this better. Okay. So then it shows the details of all these different things and details. So you can see how in very detailed definitions for each and every line in the 133. So and some of these get very technical, right? Because remember, we're dealing with every transaction, every kind of funding in the federal government, and there's a lot because we have a lot of programs and it's a complex entity. So anyways, I just wanted you to see this so you can kind of learn to go here and look at the definitions. That's the key thing. So let's go back to the slideshow, and we'll talk about Part 3, change in obligated balance. Okay, the change in obligated balances, again, is looking at what the title of it says, is the change in obligated balances. And again, we go to Appendix F, and F1 lists the summary of everything, the unpaid obligations. You can see the adjustments and things like that. And it lists each and every line number that could be used in the change in obligated balance section.
So all of the activities that could occur that would result in a change in the obligated balance section. Just to put a
Oh, go
fine
back.
point on it.
Okay. Go ahead, Courtney.
Nope, all good.
Okay.
I think we're okay.
So now, again, I do these formulas, and these are a little bit painful, but because there's a lot of different pieces to this part. And so there's unpaid obligations at the end of the year. You want to total that up, but then there's unpaid obligations brought forward from the previous year. That's 3,000. Adjustments to unpaid obligations brought forward. So there can be adjustments, and we talked about that before. There's adjustments to fix errors, which hopefully aren't very many, but also timing adjustments that Courtney told us about. And then there's new obligations to unexpired accounts, which you would think would be big. Then you add your outlays, your unpaid obligations, the unpaid obligations. So what are outlays? Outlays are when you're actually writing the checks, when the federal government is mailing checks to people, when you as employees get paid, that's an outlay. And then there's unpaid obligations transferred to other accounts. And that's when, through a law, you move obligations from unpaid obligations between accounts. Again, that's a technical thing. And then there's this concept of recoveries of prior year unpaid obligations. Now, what's a prior year unpaid obligation recovery? So let's say, go back to our Smith Consulting contract. Let's say that you obligate Smith Consulting an obligation for a contract for $1 million. And then, but then Smith Consulting, for whatever reason, never ever submits an invoice. Maybe they didn't do the work. Maybe they just said they don't need the money and they just not going to invoice the federal government. For whatever reason, Smith never obligates the fund, never submits an invoice. So then what the financial managers have to do is they contact Smith and they say, hey, how come you guys haven't submitted an invoice? We signed a contract for $1 million and we're waiting for the invoice. So then what happens is Smith can either say, hey, we're going to invoice, and then the invoice, and then it gets paid. But if for some reason Smith says, well, we're not going to invoice that amount. We're for whatever reason, they're not doing an invoice. Well, then you can what's called recover the obligation, which means you de-obligate the amount of money that Smith isn't going to invoice. And this happens with big, large contracts. Maybe, they're buying a big, giant computer system for $1 billion, and they actually only spend $998 million. So there's $2 million of obligation that's not going to be invoiced. So then you de-obligate the money, and that becomes what's called a recovery of unpaid obligations. So that amount of money is recorded because that changes your obligation balances, right? Because you've reduced the amount of money obligated and net by the recovery. Do you have anything to add to that, Courtney? Did I cover that?
No, I was just, I think it would be helpful for folks to understand the difference between an unpaid obligation and an adjustment to an unpaid obligation.
You want to explain that?
So you have the unpaid obligation. An adjustment to unpaid obligations is generally when you have that timing issue where you get an obligation when you enter into a contract, and then for whatever reason it's not recorded in the system. Sometimes it's just it takes people a while to get data into the system. Sometimes it's just that the paperwork takes too long. So just talking about, you've got your regular, your normal unpaid obligations, and then your adjustments to account for potentially missing obligations that should have been recorded in a prior year, or that were, for whatever reason, just took longer than anticipated to make it through its way through the system.
So it could happen for things like if if Smith Consulting submits their invoice, and then for some reason a federal employee doesn't approve the invoice in a timely manner, or maybe they just it came at the cross of the period. So these then they realize after they do the accounting for it that they need to make an adjustment from the previous year to reflect this invoice that was not, paid, not recorded as paying, even though it should have been, or maybe not should have been, it just wasn't. So
it was not put into the system at the time that the obligation was incurred.
Okay.
So it's just an adjustment.
Can recoveries roll up to accounting adjustments? That's a good question, but it is definitely, we're getting into the accounting area, because sometimes us budget people aren't quite as good as and you got to call your accountants. I think their recoveries can be they're recoveries that are not accounting adjustments, right? So like the example I said where the contractor just didn't invoice the money for whatever reason, that's not necessarily an accounting adjustment. That's just a de-obligation. There's a concept called de-obligation, where you essentially go in and say, for whatever reason, we're going to de-obligate the money. I mean, another example of that is if Smith Consulting signed a contract to deliver, a software tool, the software tool, and then they never deliver it, right? They just don't deliver it. And so the government says, well, we're not paying for it because it was a firm fixed price contract, and we've lost all confidence that Smith Consulting is going to ever deliver this tool. So they void the contract and they de-obligate the funds that were in the contract because of a failure to deliver the required product. So there's lots of little examples of how things can be de-obligated and result in a recovery.
And Andy, just to add another potential circumstance where this might happen, you might have a loan program where you have an agency working with a potential borrower, and they come to agreement on terms, and the agency obligates funds for the loan. And then, for example, it could be 6 months later or a year later, and the borrower has not drawn down the loan, and business circumstances might change, which means that which results in the loan no longer being needed by the company, and essentially that's just the obligation. But that's another circumstance where you can have a long time period where you think, oh, well, we've got this obligation, it's gonna get made, but circumstances have changed, the business climate might have changed, and so you're not going to take that loan anymore. So there's no disbursement. Sorry, go ahead.
Grants are also another example. Like the government could have given a grant to a particular organization, and then that organization doesn't deliver the service, so the government rescinds the grant, and so you de-obligate the amount of money in the grant. So there's many examples of how things could lead to a recovery. So then there's this concept of uncollected payments, federal sources, end of year. And here it's like the government was expecting to get money and they didn't. And then there's adjustments and there's change, and again, this is all very technical stuff. And you can find the details in Appendix F, or some of this stuff you really should go talk to your accountants. Accountants are, understand this. They know how to do the specific transactions. So next slide. Let's look at example. At the end of November, what 4 lines sum to unpaid obligations? can the adjustments be recorded in the system as an accrual? There's just questions. That's again squarely in the accounting, and you're kind of at the edges of my competence on what gets recorded into a accounting system. I'm not sure the relationship between adjustments and accruals. We'll look into that. That's something for me to research. I apologize. Yeah, that's an accounting question. And accounting, and one of the things you're learning from listening to this is learning about accounting is very useful for budget people. But to this question, I'm just going to show you the answer. So at the end of November, what 4 lines sum to unpaid? It's these 4 lines, right? Start of year unpaid obligations, new obligations, outlays, and gross. Adding those all up. So notice that they put the outlays as negatives, because remember, you're looking at the change in obligated balances. When you liquidate an obligation, you pay it off, you reduce the obligation because you're paying it off. It's no longer an obligation, it's now an outlay or an expenditure. So why do we care about end of year unpaid obligations? Just a broad, like, why are we going through all the trouble of doing this? Why does OMB care what the end of year unpaid obligations are? Any thoughts? Well,
you need to account for them in the next year, because anything that is a 1-year fund that is not being used or unobligated this year, but there's some leftover, you have to pay for it. You will have to use it from the next year budget.
Well, that's a good point. That's true. So if you have, well, now technically you can't make obligations that are in excess of your budget authority, because then you're in anti-deficiency territory, right?
Sure.
So
Right.
that's,
you have an obligated balance in this scenario. You have an obligation, a valid obligation that is just not being paid. And so, sorry, go ahead, Andy, take it from there just to clarify.
so the unpaid obligations you care about for several reasons. One, Treasury cares about this very much, because Treasury needs to figure out what the cash flow is going out of the government, right? So the more unpaid obligations there are this year means that next year they're going to have to put out more money to pay the government's bills. And why does Treasury care about that? Because it's Treasury's job to figure out how much money is going to go out each year, because they use that to figure out how much money, how big the deficit's going to be, and then how much money they have to borrow. So this is really important for managing the government's borrowing program. That's really, really important. There's another reason, though, too, why Congress cares. So Treasury cares and Congress cares because they want to know what the borrowing's going to be, how much loans are going to be, how much Treasury notes are going to be issued next year. But there's another reason. Because Congress cares very much that the amount of money that they appropriate actually gets spent to do the programs that they care about. And if there's a big unpaid obligation in a particular program, it's evidence that the executive branch is not carrying out that program. For example, if the Congress appropriates money to buy a new aircraft carrier for the Department of Defense, right? They've determined and passed into law that we need a new aircraft carrier. And so they appropriate the money to Department of Defense. And Department of Defense goes and does their competitive bid, and they issue a contract to XYZ Corporation for $400 billion to build an aircraft carrier. They want to see that that aircraft carrier is getting built. And one way to tell that the aircraft carrier is getting built is that, in effect, the XYZ Corporation is getting paid to build the aircraft carrier. If there's no payments, that makes you raise questions on whether that carrier is getting built or not. Does that? And Courtney, do you have anything to add to that?
Just that, just to amplify what you've said, which is that, Congress members are extremely interested in understanding, when the services, for which they approved appropriations actually get used, either whether it's, then I'm using services very broadly here, in terms of, it could be a new courthouse in some members' district, right? And that member is going to be very interested in whether or not that courthouse is under construction. So it's not just DoD, it's not just weapons, it's everything really, because Congress members have an intense interest in making sure that that the projects that they wanted to make sure got done actually do get completed.
Okay,
So-
so let's go to the final thing, budget authority and outlays. Now, again, the reason why this section is so important is because the projection of outlays and the outlays that are made help manage the federal government's borrowing program. That's one of the major reasons. And then also there's programmatic reasons to make sure that you understand that the money that is appropriated is getting spent the way it's supposed to be. Again, I'm showing you Appendix F. Notice they're all 4,000 and 5,000, and it tells you the budget authority gross and things like that and listed out. So let's talk about this a little bit in detail. Again, I'm trying to use this concept of formulas to show the relationships between the different line numbers. So there's the concept of gross budget authority and outlays. So what is budget authority gross versus budget authority net? So budget authority gross, and correct me if I get this wrong, Courtney, but because this is a little tricky, gross budget authority equals direct budget authority, which is outlays from new balances, and then outlays from balances. Gross budget authority includes direct obligations and reimbursable obligations. And so net budget authority is only direct obligations. So you essentially take your total budgetary resource. Yeah.
And you're breaking up, just letting you know.
Oh, okay. Can you hear me now?
Yes, it's better.
Okay. So your gross
your face is frozen, but we can hear you. So
okay. Well, if that's a problem, I'll just turn off the camera. But so you take your gross budget authority is your essentially your direct plus your reimbursable, and then net budget authority is just your direct. But here you're taking your gross outlays, which equals the outlays from new balances and outlays from balances. And again, new balances is the new balances created by new budget authority, and outlays from balances means previous year's budget authority. And then there's this other thing, offsets against budget authority and outlays. And again, it's federal sources, the interest on federal securities. So some programs like Social Security are allowed to invest in trust funds, and the assets in the trust funds are always treasury notes. And so that when they get paid interest, their money comes to their account from treasury for that. Then there's interest on uninvested funds, which honestly, I don't know what that is. Then non-federal sources of income, which could be, fees from parks and stuff like that. And then offsetting collections, offsetting government collections. So that is the formula there. And then we got additional offsets against gross budget authority. And I'm not going to go through all of these, but I think what you can do is go read the line numbers. And again, in A11, I'm repeating myself verbatim. And this shows all the detailed things. We've talked about recoveries, and adjustments. And that then equals budget authority net. Now, I know this looks a little complicated because, in fact, it is complicated, but I'm hoping it gives you just an overview and a flavor of it. So let's look at examples of this. Does line 4,000 include reimbursable authority? Can anyone say?
Yes, it should.
Yes, gross includes reimbursables. If you see the word gross, it's got reimbursables in it, right? And what line includes reimbursable collections from federal sources? Let's just go to,
430, right?
yep, 430. 1700 can be, 1700 would be in the budgetary resource section that we're dealing with. So we're now in a different section, but 1700 could, if we were dealing in the budgetary resource section, would include reimbursables, but we're in a different section of the SF 133 now. Okay, what line sum to equal discretionary outlays net for December? Take a minute here to think about what are the lines. Now, how would you do this? The way I would do this is I would be whipping out my SA11 and looking up the different line numbers. I would go to the discretionary net outlay line and I would look it up in A11. So let's see what the answer is. So to get, you add the three lines, what lines sum to discretionary outlays? So we're looking at the discretionary outlays net for December. So we're looking for this number and you add these three numbers, 433. And you can see what I've done here is I just showed you, it shows you exactly what the numbers are. So 480 equals the lines through 410 through 411, 434, 41, 20, and 24. So what I'm trying to show you is that if you ever have a question about a line, you go to Appendix A11, you look it up here, and then it will tell you how they add up. Because unfortunately, it's not clear always from this. Just reading this, you can figure it out, but it's hard. The shortcut, the correct way to do it is to go to A11 and just have that out there when you're looking at the SF 133. Okay, so let's do a conclusion. We're just going to review the purpose of the SF 133. And Courtney can chip in here. Again, it's to fulfill the requirements in 31 U.S. Code, the law that a president review the federal expenditures at least 4 times a year. We talked about how GTAS collects the data monthly, but the report that goes to Congress legally is required only 4 times a year. And then we talked about the importance of reporting unliquidated obligations and unobligated balances and canceled balances, because that is used by Treasury to forecast the amount of borrowing that is required. And it's also used by Congress to track whether programs are being implemented. It allows the monitoring of the status of funds. And we talked about how important that is to Congress to know that money is being spent the way that they intended. And then we also have seen through the Appendix F1 how the data, the common terms of the data and the line numbers apply throughout the budget process, from the Schedule P that is in the President's Budget Appendix to the apportionment, which happens after the law is enacted, to the SF 133, to the Statement of Budgetary Resources. So the data flows through both across those different reports, but also over time, so that roughly you can go back and look at, FY 18 data, 19 data, 20, 21, 23 data, and largely the same terms and concepts are used, so you can do trend analysis and comparison over time. And also, it provides historical reference. We talked about that. And it provides a basis for determining obligation patterns for when you do your continuing resolution. And then it ties it to the data to the Statement of Budgetary Resources in your financial statements. So we've kind of walked through a lot of things and covered. So I'll take a stop here and see, are there any questions? We have Courtney, who knows more about this than anyone, a lot. So if you have questions, let's take a few minutes and answer your questions. Okay.
You guys, this stuff is hard. It's complicated. It's messy. And even, even when the flow of funds works perfectly, there will always be some sort of, accounting or budgetary accounting issue that pops up. So, if you are not an accountant, and I am guessing that most of you are not technically accountants, make friends with your agency accountants, because you can help them and they can help you.
And I would say that it's good, and I totally agree that it was a lot and if we tried to break it down, and at least point you in the direction, but you can figure it out. It's just you have to go line by line and look it up and take your time and be patient, and work through it. So I hope this has been useful. If you can contact, what's the difference between gross and net budget authority again? So gross includes reimbursables, is a short answer. So a lot of accounts have reimbursable and offsetting collections added in. And that's the gross, that's the amount of money available to the particular account is the gross. So you have the money that was directly appropriated to your account plus what you collect in reimbursables. The reason you need to make a distinction, though, is if you were to add up all the gross, you would have double counting, because the sending organization would count it as an obligation, and then the receiving organization would count it. So you need to go to net to show just what the total budget authority is. Is that, Regina, did that answer your question? Okay.
Andrew, quick question.
Sure.
Is there a place where we can look up, because some things are fairly obvious where others are not necessarily. When I, for example, trying to analyze the variance totals in the reporting, and we look at a particular SF-133 line number, we are trying to puzzle out which GL codes are being included or excluded from a particular calculations. Are there some kind of like a lookup cheat sheets or something of the sort that can be used to quickly identify the correlation between SF-133 lines and the GLs and whatever other filters are being applied?
So every agency, so the question is, like, every agency has general ledger account structure, right? And the general ledgers are used, what's the accountants, and again, I'm not an accountant, so can't give the exact answer to this, but every agency has a general ledger account structure, and then they have a crosswalk that shows which accounts go to particular lines in the SF-133. And that's maintained in the Office of Finance, because it's the finance office that kind of runs that. And so I would go to your finance office or your accounting office, and they should maintain that. And every agency has a group of people who are responsible for producing the SF-133 information and uploading it up to Treasury. And it's that organization that maintains the crosswalk you're talking about. Yeah, there's someone put in the standard general ledger codes, and that. But I would go to my accountants and find the one for my particular agency.
And again, I would encourage you to make friends with your counterparts in the other offices. So if you are in budget, definitely go hang out and have lunch with the accountants. Because having an understanding of common problems that come up within an agency or a particular program, having those conversations will likely make your life, your respective lives much easier, and minimize the potential for any inadvertent errors.
Yeah, I appreciate the comment about me slowing down. Sorry about that. And Janice tried to slow me down. But I'll work on that. Okay, any other questions? Well, Janice, I think I'll turn it back over to you to close us out. You're on mute, Janice.
Thank you, Andy. Thank you so much to our wonderful presenters, Andy and Courtney, for taking the time to speak with us today. And thank you to everyone who joined us for our fall forum. As a reminder, we'll be sending out a post-survey, session survey at the end of the forum, and we would greatly appreciate your feedback. I would like to say thank you again and have a wonderful rest of your day.
Thank you.
Thank you to our interpreters. Thank you, Sarah and Rhonda.
Thanks, everyone.
I will say, this class has been the hardest one we've had to teach, and I think we're getting better.